Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And what I wanted to do in today's episode is have a think about all the ways that we can potentially navigate or mitigate the recent tax changes. And of course, I'm talking about the big one being the quarantining of negative gearing. And I've spoken before in previous episodes. Episode 416 that I recorded a few weeks ago, how about the impact of negative gearing on the internal rate of return. Notwithstanding that, then we've got higher capital gains tax as well. And so naturally, before we throw investing in property or established property out the window as a strategy, it's important for us to really interrogate any other options or strategies that we could think of that might work or help beyond what I've already spoken about, including buying new build property or investing in commercial property. Now, there's a really important point I need to make, and it's surprising sometimes that it isn't super clear. And it's my fault, obviously, for it not being super clear. But sometimes we get questions from people, and they think we're buyers agents. They think we're buyers advocates. These sorts of things. I can't state this clearly enough. We are asset class agnostic as a business and as a podcast. Most importantly, that is that I have no bias or preferences towards whether anyone should invest in shares or property or a combination. I want in this podcast to bring a completely independent, agnostic, unbiased approach to this decision. And I've spoken about before how, a lot of financial advisors don't know a lot about property and a lot of buyers agents don't know a lot about shares and super. And I feel like, I don't want to toot my own horn here, but I feel like I'm in a unique position where over the last 25 years, I've spent just as much time and experience in both of those camps. And so that's what I hope to bring to this podcast. I really want to bring to this podcast is a unbiased approach and help you sort of navigate these changes. And today's episode is exactly that, is exactly one of those opportunities that I get to sort of say, okay, let's not just say, property's no longer worth investing. Let's think about all the ways that we can mitigate these taxation changes and explore them from a mathematical and evidence-based perspective. And we've also got to be conscious that property is not the only game in town. So sometimes, and I've spoken about this in the Q&A session recently, that people that tend to be too focused on one asset class end up trying to put a square peg in a round hole, in that property doesn't really fit their strategy, but they try and make the strategy fit the asset. So they try and build a strategy around investing in property. But we've got to realize that property is not the only game in town. Now, of course, to some businesses, property is the only game in town. If we're listening to social media that a buyer's agent produces. And look, I'm not saying all buyer's agents are going to be talking about or giving the wrong advice, but of course there's a natural conflict of interest that they're talking about property and that's their business, is to help investors buy property. Now they might pivot and help homeowners, that's fine. But we just want to understand that, to a man with a hammer, everything looks like a nail. And I just hope that that's super clear in this podcast, that my goal is to really bring you an independent, unbiased sort of viewpoint. Okay, I think I've labored that point enough. Hopefully I've made that clearly enough once and for all. But just as a recap, the negative gearing quarantining, so the fact that you can't benefit from negative gearing today, you've got to carry forward that loss. And my projections estimate that then you'll be able to start utilizing that loss maybe somewhere between 10 and 20 years after owning the property for 10 and 20 years. And it might take you 30 or 40 years to fully use up those carried forward losses. And so the time value of money means those tax deductions are worth a hell of a lot less than what they're worth today. And as a result, it contracts the internal rate of return on after-tax basis from 11%, and that 11% assumed 7% capital growth, 3% gross rental income, to about 8.4%. So 8.4% after-tax isn't still that bad a return, but then when you overlay the fact that it's a liquid, you've got to go out and borrow money, so it's really signs you up to an ongoing commitment. You've got, stability of income because, potential maintenance costs or vacancies, these sorts of things. And then you've got tenancy laws and legislative risk to sort of navigate as well. So my view, as I've previously stated in previous episodes, is 8.4% probably isn't enough relative to other investment options. Like I could put the money into super, I could invest in the share market. And so those changes, and particularly quarantining negative gearing, have substantially reduced the attractiveness of investing in established property. Okay, that's just a bit of a recap and to really position today's episode. Now I want to talk about the 6 potential levers or strategies that people could, or we could as investors, utilize or implement to try and navigate or offset some of the impact of these taxation changes. And I want to interrogate each of these individually and see which one can potentially work and what are the risks, opportunities associated with each of them. Okay, so lever number 1 I want to talk about is chase a higher rental yield. Now, of course, the problem with the quarantining negative gearing is that the cost to hold on to a property or to service the holding cost is much higher without negative gearing. So let's say the pre-tax loss of a property is, say, $25,000. So the net rental income you receive less the interest, you're short $25,000 a year before tax. Now, if you get negative gearing benefit and you're on the highest marginal tax rate, then that really takes the cost down or reduces the cost to $13,000. So it's far more affordable to hold on to that property because of those tax benefits. So the quarantining really costs you $12,000 in this scenario, $12,000, the difference between $25,000 and $13,000. Now, one way to combat that is to target properties or target strategies that generate higher rental yields. And based on my calculations, we need to achieve a starting rental yield of 5.5%. And if we get 5.5%, that will, even if negative gearing is quarantined and we pay the higher rate of capital gains tax, effective rate of capital gains tax, we end up with an 11% after tax internal rate of return. So it's the same as what it would have been with negative gearing, but albeit a lower rental yield. So really, just to recap, the numbers I did previously was a gross yield of 3%. So if it goes to 5.5%, we're no worse off. So there's really 2 ways that you can increase your rental yield. The first is location, and typically higher yielding properties tend to be in outlying or regional locations, and that's just because rental supply of, established property on a permanent basis tends to be pretty contracted, and so rental yields tend to be higher. Also, because the supply and demand fundamentals, capital growth is lower, and so the market is pretty efficient, and it rewards owners with a higher rental yield to somewhat compensate for lower capital growth. But remember, as investors, we don't want to make that compromise. We want still the high capital growth and we want the high rental yield if possible, right? We'd never ever want to compromise on capital growth, because even if you chose a property in an outlying area and it delivered a 5% gross rental yield, to achieve an 11% after tax internal rate of return, which is kind of our benchmark, you would need 6% in capital growth over the long run. So essentially, you would need an 11% return, 5% yield plus 6% capital growth. Are you going to get an 11% return from a property that is in a location that, doesn't benefit from the supply demand fundamentals that an inner city location does over the long run? Now, of course, I think the answer is no, or at least very unlikely over a projected period of time. So certainly we could go outlying areas and target properties with high yields, but if that comes at a cost of lower ongoing growth, that's not ideal. Remember, the whole thing around property is compounding capital growth. I want to hold an asset that doubles in value, 7.2% annual return, doubles in value every 10 years. How can a property be worth 4 times the value in 20 years from now if we don't have the buyers for that asset to have the financial capacity to pay 4 times more in 20 years' time? That the average Australian is not going to be able to do that, so you need to invest in an area where that's doable. I've spoken about that before. The second way of increasing the gross rental yield is by size or finish of the accommodation. So that could be renovating a property, adding a bedroom, could be building a granny flat, these sorts of things. Now, you can certainly do that. If you buy an asset in a fundamentally sound location, you could certainly do that. But of course, that comes at a cost. So you've got to put in more capital or have more borrowings, which give rise to a greater negative cash flow as well. So what you want to do is be able to spend very little money on the property and significantly improve its income. That's challenging to do. But you should never do that and compromise on locations. So in terms of increasing rental yield. It's possibly doable in some situations, but you really need to pull the numbers apart and really make sure that, hey, if I'm going to go and build a granny flat, okay, I've got to borrow more money or put more capital in. My cash flow is going to be different. How much will my income increase by? And am I in a better position? Am I getting closer to a 5.5% gross rental yield for me to be able to do that? However, maybe in the future, the market might open up some opportunities that actually deliver much higher gross rental yields. So I've been doing a bit of work on this with a lot of thanks to Jared and Jordan from Wakeland Property Advisory, who run a great business and they're very knowledgeable. Anyway, we've been just sort of workshopping, or I've been asking really about rents and values and so forth. So they believe that you can go and buy an investment grade 2-bedroom apartment or villa unit, something older style, something with strong land value component, for around about $900,000. And that property today will rent just broadly, roughly, for about $750 a week, which equates to a starting gross rental yield of 4.3%, which is pretty strong, right? Historically speaking, it's pretty strong. I've always done my numbers on sort of 2.5% to 3% in terms of gross rental yield. That sector of the market is, pretty strong in terms of rental yields. Now, it's been well documented, of course, that since the start of this year, property prices have been falling, particularly in Melbourne and Sydney, and they've started to fall, I think, albeit except for, I think the only outlier is Perth. It's started to level off. It hasn't fallen yet. And the two things that have contributed to price declines, obviously 3 interest rate increases, and then, of course, the negative sentiment around the taxation changes. And I think most market commentators expect that prices will fall further. As I've said previously, I think it might have been on the Australians podcast, that, look, I wouldn't be surprised if prices came off by 10% this year or over the next 12 months from May 26 to May 27. I just wouldn't be surprised about that. But also, equally, I wouldn't be surprised if they only came off 3%. So I don't have a strong opinion here, but I'm certainly open to the prospect that, yes, they're going to fall. The other commentary is that people expect rents to rise in real terms, in dollar terms. And I think that's true too, but I don't think rents are going to go through the roof because renters not very elastic in terms of affordability. There's only so much a renter can afford to pay to be able to rent a property. Now, remember the starting rental yield, so how much rent as a proportion of the purchase cost, is the most important measure from a cash flow perspective. That's going to dictate the property's cash flow and how much capital you need to contribute towards that property from the outset. Now, of course, interest rates can change over time. That will be a variable component. But if I can buy a high growth asset at a high starting yield, that's really good for me because my cash flow outlay is going to be much smaller than it otherwise would. Now, of course, we tend to look at yields based on market value of an asset, and that's a good measure too, but that's more of a theoretical measurement because the yield can change relative to market value as a percentage, as a proportion, but it doesn't change your cash flow, right? So both are kind of important measures or metrics to look at, but I think the key point here I want to say is that your entry yield relative to purchase price will dictate your future cash flow, and that's what we need to understand. So on my modeling for a $900,000 investment property, we need a gross rental yield of around 5.3 to 5.4%. And if we do that, we'll achieve a internal rate of return after tax around about 11% per annum, which is kind of our target rate. So if we go back to the villa unit 2-bedroom apartment example that I just shared, in terms of today worth $900,000 renting for $750 per week. Well, a couple of things could move, of course. If the value of that particular asset dropped to $850 and rents rose by $100, we would get to that 5.4% benchmark. If the value of the property fell to $800,000, so by $100,000, and the rent rose by $50 a week to $800 a week, we're also then at that benchmark. So I guess what I'm saying, and I think this is particularly true in Melbourne, just because property, broadly speaking, and particularly investment grade property, broadly speaking, is intrinsically undervalued. That's kind of our starting point in this market condition. If we see values compressed further in Melbourne, which I think we will, and if we see rents rise further, which I think we will, the only question will be, will values fall far enough and rents rise high enough for the yield to achieve that 5.3, 5.4% benchmark? And if they do, it could be an investment opportunity. It's not there yet. It's not attractive enough yet, but it could be, even though negative gearing is quarantined. Now, of course, the big proviso here that I can't state highly enough is that you don't compromise on capital growth. So we're talking about in good quality investment grade assets, strong land value component, unique tight supply, broad-based, multifaceted demand, all the things that I've spoken about before. So we don't compromise on quality, but it's the price. And if the price becomes attractive. Now, the kicker could be that we go and buy an asset like this, say, next year, and then we have an election in 28 and negative gearing is reinstated. If that happens, then we're definitely off to the races, right? But there might be a point in this market cycle where yields and values are so attractive, particularly in Melbourne, but I mean, I'm open to really anywhere, but I think Melbourne is the most likely location to offer these sorts of opportunities, and there could be an opportunity here. So lever number one in terms of higher rents to manufacture them, maybe to target locations, outlying locations that have higher rents, no, because we'll compromise on capital growth. But if the market corrects in terms of lower prices, higher rents, we could achieve a certain benchmark. So lever number one, we'll call it as a possibility. Okay, so the next lever I wanted to talk about is gearing, because I've heard some commentators, people being interviewed, that, because you're not rewarded for negative gearing anymore, so having a rental loss, maybe the answer is to put more cash into the property and gear it to a lower level, and maybe even gear it to relatively neutral so that you're not crystallizing a negative gearing loss, and you've got more money in the asset and you're no longer rewarded for borrowing 100% of the property. So that might be the best way to go. So what I did is I modeled buying an investment property for $850,000, initially borrowing 100% and then aggressively repaying that loan over the first 10 years of property ownership. And essentially the investor needs to repay around $43,000 a year to get the loan principal down to about $415,000. So broadly speaking, just slightly less than 50% gearing. And I projected that in year 11, then the rental income is projected to exceed interest by about $1,000 a year. So it's positive, but only just slightly positive. And so that could be one way to kind of mitigate the carried forward gearing by negative gearing losses by aggressively repaying the loan so that you can utilize those losses, those carried forward losses sooner. However, the downside is you've got to put in an extra $43,000 a year into the asset to do that. That's more of your own capital, and that weighs on the internal rate of return. So I calculate the internal rate of return then falls to 7.3%, which is worse than actually just keeping the gearing and carrying forward the losses. And this analysis is a good reminder of why borrowing to invest in established property used to work so well before the tax changes. Firstly, because the only cash contribution you make is towards the holding costs. You go and borrow the full cost of buying that asset. You don't put any of your own money in. You use other people's money, the bank's money. And the only money you need to put into that asset then is the cash flow. And secondly, because you've got a tax deduction for putting in that cash flow, it dramatically reduced the amount of capital you had to put in. Didn't change the growth of the asset, of course, and therefore you ended up with a double-digit after-tax internal rate of return. But putting more of your capital in, so either initially upfront and borrowing 80, 70, 60, 50% of the property, or aggressively repaying the loan in the first few years, it only drags on the internal rate of return because you're putting more of your own money in. So number two, using gearing to aim for more of a neutral cash flow is a no. It's not going to work. It's not going to get us back to where we need to be from an internal rate of return perspective. Okay, lever number three is using a company to preserve the negative gearing. Now, I wrote about this last year, episode 350. So if you want to go back and have a look at that episode, because I'm just going to sort of give you a brief overview, but let me try to explain it as simply as I possibly can. Essentially what happens is you establish a new investment company, non-trading company. The company issues you with 1 million shares at $1 each. You go to the bank and you borrow to buy those shares. So you might borrow against equity in existing property, so forth, and you pay the company that $1 million to buy those shares. So you've got the loan in your name and you own the shares in your name. However, now the company has $1 million inside of it because it's raised share capital. The company then goes and buys the property itself. It doesn't need a loan because it's got the share capital that it's raised, the $1 million. In the company will earn rental income, of course, and then it will have deductions for expenses, but no interest because, of course, it didn't have to go and borrow that money. So the net rental income in the property can then be paid out to you via a dividend, and it comes in your personal name. So in your personal name, you own the shares, you get dividends from those shares, but because you borrowed to buy those shares, you've got the interest deduction. And essentially, if you really look through it, essentially buying the property in a company, the company's not recording a rental loss. The income that comes into your name is dividend income, and we can use negative gearing with shares. And that could be one way to, avoid or navigate the negative gearing quarantine rules. However, the big problem is Part 4A of the Tax Act, which is an anti-avoidance measure in the Tax Act, which says if the dominant purpose of doing something is to obtain a tax benefit, then it's considered tax avoidance. So to avoid Part 4A, an investor needs to have a genuine commercial reason for structuring their property investment that way, other than to achieve an outcome. And we can't think of a good reason to do that. You can't argue asset protection because the share's in your name. And, if you had the property in your name, you wouldn't get the negative gearing benefit. So clearly there's a tax benefit there. And we think it's just too aggressive. There's nothing in the legislation or the law at this stage that would prohibit something like that. But if people started to do it, they would certainly then legislate against it. And then what are you going to do? You're going to have to sort of unwind that situation, maybe transfer the company, pay stamp duty again. We just think it's just too aggressive. There's also a practical funding problem as well because, you need to have enough equity outside of that particular property purchase to be able to fund the full cost. If you want to use that security, then you've got to find a lender that's going to allow you to take a guarantee from the company. That's all really messy. So it's going to be difficult from a lending perspective as well. There might be some small opportunities for people that have a lot of cash in a company. And so they might use the cash to go and buy property and then borrow in that company to go and buy shares. So are coming across scenarios where we might be able to use those sorts of things, but just generally using structures to get around these negative gearing rules, just be very, very wary of something like that. At least at this stage, we're not a big fan. Okay, the next one is buy a new dwelling. So, of course, if you buy a newly constructed property, you get to keep the 50% CGT discount and also you get the negative gearing. Of course, new build properties are constructed in location where land supply is abundant. It's not scarce, which is obviously going to retard its future capital growth rate. Plus, more than 50% of the purchase price tends to be in the improvements. And of course, generally buildings depreciate and land appreciates. So if you're only putting less than 50% of your money in the part that's going to appreciate, that's no good as well. And that's going to weigh on future returns. The other secondary problem is that I think there will be no doubt there's going to be an increased level of demand for new property by uneducated investors, but developers won't be able to increase supply necessarily fast enough in terms of getting approvals and, buying the land, all those sorts of things. So there could be very high demand, very low supply, a little bit of FOMO kicks in, people are chasing tax benefits. And to what extent are those tax benefits that are only unique to the first purchaser, to what extent are they capitalized in the purchase price? Are they reflected in the purchase price? So I think this market will become overheated, particularly driven by investors. So notwithstanding that it's not an attractive option anyway, essentially people will be buying average quality or very poor quality assets in terms of assets that have the attributes to drive growth, and they'll be overpaying for those attributes. Alternate to buying kind of a house and land package in a land release location, an alternate could be, buying a brand new townhouse in a sort of secondary suburb. I say secondary suburb because townhouse developments, small scale developments, whether it's 2, 3, 4, 5 on a block, tend to not really work in blue chip locations because it's just not economical for developers because the land costs too much. So typically developers build these sorts of accommodation in secondary suburbs or even outer-lying suburbs. And also because of land costs, quite often they build on busy main roads and impaired locations. So I guess you could go and buy a new property, townhouse or something like that, but you just have to be very, very careful. I think it's very unlikely you're going to find one that's in a good location where you're not spending the vast majority of your money on the improvements and you're getting very little land for it. And I think that's going to be really difficult to do. So it's probably, to leave a 4, buy a new dwelling, it's probably a no. Lever number 5 I wanted to talk about was the small scale property development. What if we qualify for increasing housing supply and getting the negative gearing? What if we go and buy a family home, demolish it and build 3 townhouses? There's a couple of issues or concerns I have with small scale property development. First one is it's more akin to a business than a passive investment strategy. You've got business style risks like cost overruns, inability to maximize value because of planning restrictions, shift in markets or interest rates, whether you've got enough equity and borrowing capacity to be able to do it, whether the completed product sells for what you expect. All these sorts of things requires experience, temperament, time, and a good asset backing to successfully complete it. So it's not something that, I can pivot from a passive strategy into something like this. Look at it like I'm starting a business and it's going to have certainly a different risk profile. And not everyone's going to have the knowledge, time, and temperament to do that. Also, the other challenge, and one that we've seen, which is absolutely horrible, is we've seen buyers agents out there promoting development sites. And when you actually do the feasibility study, they were never feasible to develop in the first place. So, there's this saying, never take advice from someone that doesn't have to live with the consequences. And it is, in this situation, it's perfectly true. Like if I can just sell you a property and move on and I don't have to live with the consequences, then I'll just tell you, if I don't have much in the way of morals or ethics, I'll just tell you whatever I need to tell you to get the sale through. And unfortunately, we've seen that happen a lot. So if you're going to look at a development site, someone that is completely independent to either review or prepare a feasibility analysis, a financial feasibility analysis for you. We do that often at Pro Solution for our clients. Our accounting team does that for them. And it's a great sanity check to really understand that if that's what your plan is to develop this site, let's make sure that using reasonable but conservative assumptions, you're actually going to earn a return on your investment. But look, the reality is that the goal of investing is to, invest and get compounding capital growth. And if I get 7.2% compounding growth, my asset doubles in value roughly every decade. That means after 30 years, my asset is worth 8 times what it is worth today. But in the first decade, I only get 14% of that return. In the last decade, I get 57% of that return. That's how compounding capital growth works. It's not about building properties, flipping them and making short profits. It's really letting compounding capital growth rate do the heavy lifting. So lever 5, small scale developments, is a no. Okay, lever 6 might be a high yield specialised type properties. So this could be things like NDIS housing, co-living, boarding houses, student accommodation, short stay properties, these sorts of things. A couple of observations with these types of assets. The first one, and I've seen a lot over the last couple of decades. The first one is gross rental yield might be attractive, but let's have a think about net rental yield. So particularly with things like student accommodations, short stay properties, even boarding houses to some extent, they tend to attract higher costs as well. So when you look at the top line, you go, wow, that's a lot of rent. But then you've got to look at what are all the expenses. And sure, the net rental yield's still probably going to be higher than a standard permanently occupied residential property, but maybe not as high as you initially thought. The other issue is, to what extent does the price and value of the property reflect its use? So, for example, if I go and buy an NDIS house, for example, I'm probably buying a house in a pretty ordinary location that has been overcapitalized because it's built for a specific purpose. And then that property is going to attract a high yield, so that high yield is reflected in the purchase price. But what happens if the government has a change of heart and decides not to rent that property anymore, or put provisos over it, or make it more difficult? What else can I use that property for? And then how does that impact its value? It's quite simply, if you've got to convert it into a normal residential house, you're probably going to lose money both on terms of income and also capital value. Similarly, like boarding houses, co-living, student accommodation, again, if there's a change in legislation that requires you do certain things that give rise to costs or prevent you from being able to run that asset like that, then again, what happens to the value of that asset? If you can't use it for that specific purpose, is the asset then worth a lot less because it's going to generate less income? And that's a risk. And finally, you got to think about the capital growth rate. Of course, location, type of asset, all those sorts of things. You got to think about, yes, the income could be good, but what about the growth? As I said previously, you need both. At least you still need pretty healthy capital growth if you're going to get a high rental income. So leave the number 6, high yield specialised property. No, thank you very much. And this is not a lever because it's not really residential property, but I just reminded that I did an episode 412 on commercial property and why I think commercial property is unattractive at the moment. Remember, in Wealth by Design, I talk about a value-aware asset allocation, which is really about buying high-quality assets at attractive prices, not average quality assets at very high prices, which I think probably describes the commercial property market as I see it. So when we look at cap rates in terms of what's being paid for these assets relative to history over the last 30, 40 years in Australia, they're very elevated. So cap rates were compressed when interest rates were zero, but they haven't adjusted for higher interest rates in that small scale commercial property market. So please go back and have a listen to episode 412 if you want to learn more, but it's a hard no to commercial property. So as I said at the beginning of today's episode, the whole team and I at Pro Solution have thought really deep and long and hard about what can we do to navigate these changes? Are there any structures we can use? Are there any different approaches we can use? And this is really sharing that sort of analysis. And essentially the answer is no. The answer is, well, the market could unveil some potential opportunities where the gross rental yield becomes so attractive that it's worthwhile investing, even though you don't initially get the negative gearing benefits. But apart from that, nothing else is really that attractive. So if you start to see a whole bunch of ideas being promoted on social media, in blogs or podcasts or whatever, and they look like some of these ideas, you just want to really interrogate them from a fundamental and mathematical perspective to really ensure they're going to work. And of course, if we start to notice and see any of these strategies that we haven't spoken about advertised, you can be sure that I'll do an analysis on them. Okay, might leave it there for today. Tomorrow, I've got the last of the series, the 8 series of comparing Investopoly to Wealth by Design. So back to next week, back to only 2 episodes a week. And next Wednesday, Campbell's sharing a episode on liquidity. So until tomorrow, bye for now. Okay, before I wrap up, just one favour to ask. If you got something out of today's episode, the best way to support the show is to leave a rating on Apple or Spotify or wherever you're listening. A couple of ways that I can help you in return. If you want to submit a question to the show, the email is in the show note. Also, we've got 3 downloadable guides, which you can download off our website. One's a very detailed report on how to choose the best super fund. We've got a debt recycling starter guide, and we've also got a decision tool to help you navigate the tax changes. And finally, if you haven't already grabbed a copy of my new book, Wealth by Design, it's out now, and it's got a very useful AI companion tool with it. Anyway, I'll leave it there, and thanks for listening. Until next time, bye for now.